Good morning, this is BT Wall Street. Today in this video we are going to discuss the CPI data that drove the markets in the last week. Well, the CPI data was likely higher than expected. The market consensus was expecting 8.1% when we had 8.2%. The surprise was in the core CPI, which was 6.6, one of the highest of the year. Well, at the earliest stage of the trading session, the market, the S&P 500 fell significantly and quite sharply. Also, the US dollar appreciated against the other currency, but in the next hour we will see we show a reversal in this movement, and the S&P 500 start to rise a lot. We had a 6% intraday between the lowest point and the highest point. We reach the 3500, and then we reach the 3700, which is quite a lot, no? It was a really crazy season. And also with the we saw the US dollar depreciating a lot. Well, what the market or what happened that day? Well, at the first is clearly is crystal that a bad data of inflation mean really hawkish, a more hawkish Federal Reserve, which mean depreciation of the financial asset and appreciation of the dollar. This was the first movement. But then I think that we had two main points that reversed the trading session. The first one, I think, was the cancellation of a speculative position. We had a lot of put option in the 3600, when the market fall, simply this retail trader or this, well, we have a lot of retail traders and a lot of institutional traders in the 3600 point of the S&P 500 option put. So I think that they made money. They sell the put option, so the market makers have to buy them and cover the position buying future. So we saw a massive sellout of the put option, and then obviously the market the market went up significantly. Well, this is one of the main reasons. The other one was to, I think that the market analyze in a cool way the inflation data. The inflation data was bad, but the inflation data has been declined through this year. Also, a lot of discussion came up with the core inflation data, which was really worse than expected. But a lot of, for example, the Bank of America, before that we have the core CPA data, told that the rent, the house rent, was going to affect significantly the CPI inflation data, and this data was going to be worse than expected. So we already knew that the data was going to be bad. But what do I mean with that? That the rent came with a lag in the data. You know, we have a worse CPI data than expected, but this data came with a lag because we have several indicators that the rent in the United States is coming down. So in this sense, the core CPI inflation, in the sense of the rent, which affect negatively the last data, is going to coming down. So now we have a tremendous battle between the bears, the bear case scenario and the bull case scenario. The bear case scenario is now is reflecting in the market, sadly, that the Federal Reserve is going to hike rate with no compassion until until something break, hurting the demand, hurting the economy, bringing the inflation down. This is the bear case scenario, and with all the data, they have all the support. The bull case scenario is very unpopular because the bull case scenario needs that the Fed pivot or slightly change their comments about hiking interest rate. We are alone in this bull case scenario. Nobody want to hear it. There are some people that tell this, that the inflation data is coming down. We saw the retail sell at 0%, so no change when was expected at 0.2%. We have a clear indicator that the demand power is coming down. We also have the indicator that the rent is coming down, and this was not reflected in the CPI, in the core CPI, because the core CPI came with a lag in the sense of the rent. We also have an important data that the oil production have been cut by 2 million barrels per day, and the oil prices aren't going up as supposed to. This is a quite indicator that the demand is hurting and is counting more than the cut in the production. So we will see oil prices remain unexpectedly low or below to $90 per barrel, which is quite significant and nobody is talking about. And we have seen deflationary pressure, no? The payroll in the United States are coming down also significantly. The jobless claim are coming up significantly also. So we have a lot of data to analyze. Nobody knows. Well, we analyze this data, but the Federal Reserve has to look into this data and make a decision. The market are trying to figure out what the Fed is going to do. So one day we have a really bear session, and the other one a really bullish session, and the market is trying to find direction. Well, the market consensus is that in November meeting we will have a 0.75 percent of hike in interest rate. This is what's discounted now with a probability of 100%. But the interesting data and the bad data is that in December we will have a 0.75% hike again against the consensus of the market a month ago, and now we have almost a 70% probability of this hike. Well, I think that the base case scenario is that this 0.75% is hurting the market right now. I think that this is not going to materialize. We won't have. I bet that we won't have a 0.75% hike in December. This is against the consensus, and this is going to be a favor for the bull case scenario. So we will see how things develop. We will see what the Federal Reserve is going to do. This is going to determine the future of the market. For now, the markets are what we have. This is an objective data. The market are discounting a really hawkish Fed, and this is why we have in the minimum of the year in the S&P 500. This is why we have a really strong dollar. This is why we have a peak in yields. Um, this is what the market is discounted right now. Really bad scenario. The bull case scenario, I think that was in that the data, the deflationary data come up and the market try to interpret that this is gonna mean a really dovish or more dovish Fed, this is gonna be really good for equities. We have we had we have to be prepared for this moment. This is when the huge buy opportunity will come up, because we have seen a huge decline in the stock all around the world. The change of the tone in the Federal Reserve is going to be the key to be long in equities, long in bond. And I think against the consensus that this scenario will come up in this month before the year. Remember, the key of the market is discounting a really hawkish, more than expected hawkish, 0.75% hike in interest rate now in November, which is gonna be 0.75%, and 0.75% in December. This is key. This is the market is grown about it. It's gonna be 0.50%. So thank you so much.